Good morning, welcome to ANZ News. End of week, Friday the 28th of May. Early days for precious metals. Yesterday we shared an excellent report from Crescat Capital about the economic setup in the US, particularly around the impacts leading to inflationary pressures and what that means. Topically, overnight we learned that Biden is proposing federal government spending to jump. That's right, to jump to $6 trillion next year, the highest since World War II. Today we share Crescat's conclusion as it relates to bullion. Early days for precious metals. This from them. We believe overall equities will continue to underperform commodities, especially monetary metals. Philadelphia Gold and Silver Index to S&P 500 ratio is now breaking out from an important resistance and looks to be resuming an upward trend initiated in the fourth quarter of 2018. As long-term investors, we appreciate how much value can be unlocked in the gold and silver mining industry while also offering an incredible growth opportunity. Here's that precious metal stock to S&P 500 chart for you here. One of the key macro drivers for precious metals continues to be the fact that nominal rates are currently well below the levels of inflation. On our latest report for Producer Price Index, or PPI, the number came out with a decade-high growth of 9.5% on a year-over-year basis. When you subtract 10-year yields to the PPI data, the number is close to negative 8.6 today. The spread is at its lowest level since the mid-70s. Here's that US 10-year real yields with PPI. Silver is the single most important asset that we as a firm are focused on. If we had to boil down our entire macro thesis into one position, it would undoubtedly be that. Once silver breaks above $30, we believe we will see an explosive move to new highs. We're going to show this next chart here, almost perfect double bottom on silver to M2 money supply ratio. Here's that chart here, silver to money supply. On a quarterly chart, it is truly astonishing to see silver hanging around such a historic resistance, while sentiment remains mostly bearish. We believe the metal looks poised to another explosive move to the upside. Here's that silver position here, quarterly candles. While the demand side of the precious metals thesis is incredibly compelling, the supply side is probably even more so. The aggregate CAPEX for the largest silver miners today just declined again, reaching a new decade low. On a year-over-year basis, capital spending is down 26%. Here's that silver miners CAPEX cycle chart for you here. Scarce commodities and scarce labour. Here's a classic early sign of a commodity cycle. The mining industry non-farm payrolls is now near historic lows. This happened in the early 1970s and in the 2000s, both marking the onset of a commodities bull market. The labour and capital constraints are the amplifiers of a bull market in resource stocks. Here's that chart here, commodities versus mining labour market. You can see us almost down to those levels in the 1970s and the 2000s there in that chart. Obviously, all commodities are not mining job related, but next we're going to show you the non-farm payrolls for the oil and gas extraction industry, which is also at historical lows. The new green political agenda has hardly even started yet, so we can anticipate what will happen there. Non-farm payrolls for oil and gas extraction job roles there in thousands of people. This pandemic has truly magnified a long-term trend of labour reduction and underinvestments in the commodities space. Resource companies have been facing a deep recession for some time now, with not enough workers willing to enter this industry. On top of that, government policies seem to be discouraging folks from return to the labour market. In fact, as we're going to show in the next chart, people continue to leave the labour force like never before. Is that US total population out of the labour force year-on-year change in percentage points. In a recent interview, Minneapolis Fed President Neil Kashkari made the following statement after the latest jobs report disappointment. For all those people who have been saying, oh my gosh, the Fed needs to normalise quantitative easing, today's job report is just an example of that we have a long way to go. And then subsequently said, we heard all the same anecdotes. Yes, of course, there are people who are on the sidelines and who are getting generous unemployment, and they're saying, yes, we understand the labour market will be strong in 3 or 4 months. We know that the dynamic is there. It is funny how he expresses his concerns about the labour market to justify the current policies, to then admit that the same policies, fiscal spending mostly funded through Fed stimulus, are also playing a major role in discouraging folks to return to the job market. Their own answer to their problem is what is worsening the recovery process. Global fiat debasement. Central banks are ultra easy across the globe, and it seems to have no end in sight. This next chart we're going to show you shows that global central bank assets have just reached 31 trillion for the first time. Probably not something to be celebrating, but here's that chart here. Treasury market dependence on the Fed. The recent increase in Treasury issuances is in perfect alignment with the market dependence on the Fed to continue monetizing debt through large quantitative easing programs. To note, in the last 2 months alone, the US government issued $614 billion worth of notes and bonds, and the central bank only bought 26% of the total. To put that into perspective, the amount represents the lowest 2-month purchase relative to the issuance size in 1 year. Since foreign investors also do not participate at the same historical level we've seen in the past decades, the excess supply added tremendously to the upward pressure in yields in the last months and created severe headwinds to high multiple stocks. Here's that Treasury bonds and notes issuance chart here for you, just so you can see some comparison there. That's in monthly amount in USD, millions of dollars. And so in a world of excess supply of fiat currency, the contrast to the tightening supply of hard monetary assets such as gold and silver is so incredibly stark that more and more investors are starting to understand what comes next. Whilst debate continues over this inflation is transitory or not, we potentially remain, as Crescat has said, in the very early days of this precious metals rally. For context, gold and silver as an investment remain below 1% of assets held globally. If that merely doubles to 2%, still an incredibly low number, you have just double the demand for something that has an extremely limited capacity and arguably diminishing to expand. In Economics 101 equation of supply and demand and price, that leaves but one variable: price. Well, everyone, thank you for joining us for news again this week. Remember, jump over to ainsleyBullion.com.au for all things physical, gold, silver and platinum, ainsleywealth.com.au for all things cryptocurrency, and goldsilverstandard.com for our own cryptocurrency built and backed by real gold and real silver. Enjoy your weekend, everyone, and we'll catch you on Monday for more news.